recorded. Okay, so for anyone watching this later, we are Thursday, November the 27th. We're doing an open call. And the point of this, guys, is just if you have any questions at all, which I can help with, I will do my best to answer. Just to give you a bit of background, like I trade across a lot of different futures products, do a lot of options, a lot of bonds, you know, a lot of stuff. I've had experience in hedge funds, systematic hedge funds, macro discretionary. So maybe I have something to contribute here. Risk management, done a lot of work on risk management over the years as well. So yeah, so let's try and have a few questions, maybe even trades or just like geopolitics. I don't know, whatever. It's sort of an open house. So I'll do my best to answer. So who has a question? Does anyone have a question?
I have a question for you, Angus.
Oh, Yassine, hello. How are you?
I'm good, Angus. What about you?
I'm very well, very well, I have to say. Yeah. So what is your question, Yassine?
Yeah, so as you see, last week and this week, we saw a lot of development about the Fed and the expectation of the Fed.
Yeah.
And my question is, Friday, we had a comment of, I think, Williams
Okay.
about a potential rate cut in December.
True. Yeah.
And Monday, we had a comment of Dali, I think,
Yeah.
regard the potential cut during
Yeah.
December.
She said she maybe wants to cut. Yeah.
Exactly. So my question is that only the SOFR contract and the Fed fund future get hit harder by by this comment, and the short end wasn't affected at all, the 2 years and the 5 years. However, Tuesday, when we had rumors about Hassett as a potential Fed chair and the lower than expected initial jobless claim on
Yeah.
Thursday,
Yeah.
we saw that the short end reacted harder on this news, but
Okay.
not the SOFR and the Fed fund futures.
Okay. So the first thing, okay. So when you say the short end, I assume, Yassine, you're referring to
Futures.
ZT, for example. Okay.
Yes.
So the thing is, do we all understand what we're talking about when we talk about ZT? It's like the 2-year bond. Well, actually, it's a futures contract, so it's a derivative, and the underlying is the cash bond. Because you know, if you have $1 million in cash, you can just go and buy a cash bond, 2 years maturity, right? So keep in mind the futures is a derivatives contract. Now the SOFR contracts to which Yassine was referring, secured overnight financing rate. It's the old euro dollars. So that essentially is it takes a 3-month period, right? So let's say we talk about December 2025, and essentially what it is, it's looking at the average price of the overnight rate for that 3-month period. So the first thing to keep in mind, Yassine, is that it's an average. It's an average of that period, right? Or what the market thinks the average will be. Okay, so that's the first thing. So it's a 3-month period. Okay, so when you talk about December, it actually expires in January, and so it's like what's all of that. So your question is, well, okay, why do they react, or are they more sensitive? Remember that the SOFR contracts, as you know, they're much more focused, ciblé, right? Like on a specific month or Fed meeting, which so the question therefore is
Why there is not a sync between the SOFR and the short end, the two
well,
years?
there is, but remember that the 2-year, think about what the 2-year bond is. The 2-year bond, or the ZT, is essentially saying it's looking at everything. It's essentially eight different SOFR contracts. Remember, a SOFR contract is 3 months, right? 3 months. It's only interested in a 3-month period. The 2-year bond is essentially taking 8 quarters to make 2 years. So the question is, you know, the thing about the SOFRs and the 2-year is that if the market believes, so let's say, for example, December, let's look at December, guys. I want to show you a couple of things here. Let's see what we can do. So hold on, just give me a second here, guys. Stop share. I just want to show you something, and maybe I can help. Okay, so what we've got here, guys, today's a bit strange because, you know, the markets are about to close and a lot of things. But let's look, this is an option chain for ES futures, but we're not going to look at that. Let's look at, I want to bring up The so here's the SOFR contracts. Okay, can you guys see this screen here?
Yeah.
Yeah. So you see the SOFR. This is a 3-month contract. So you see December, March. You see they have different. Now, what do you notice about the prices? What do you notice about the prices? Are they the same?
No.
They're all different. So why are they different? And by the way, do we know what these prices mean? What is this price? It's telling you the implied rate, right? So what you need to do is to take 100 as a base value, and then you subtract this. So if we look at, let's say, for example, December, and again, I'm going to simplify a little bit. So what is that telling us? So we go 100, we subtract 96.265, and that comes with 3.735. Everyone following this? So what is that telling you? Why is that price 96.265? That is telling you that the market believes the Fed funds futures, actually, no, not the Fed funds futures, the SOFR rate, which is close to the Fed funds futures, for on average in this December period, actually 3-month period, will be 3.73. Okay?
Till March?
No, because the December 25 contract, actually, let's make this a bit bigger. The December contract, as you'll see, oops, where is it? Oh, here we go. Can you guys see a gray thing here? Probably not.
Where?
Yeah, no, I have to keep on sharing the screens. It gets tricky. Here we go. Okay, so this is the December contract, and this is another thing, Yassine, to keep in mind. So what is it called? It's called December contract.
Okay.
But very important, when does this expire? March the 18th. March the 18th. So the thing about the SOFR contracts is that the SOFR contracts, when it says December 25, it's not only for December. It's a 3-month period. And in this case, it's basically from December until March. And the price is essentially what the market believes is going to be the average individual day overnight price for that 3-month period. Now, the thing is, so it's not exactly what the market thinks the Fed will be doing for the December cut. It's essentially saying December, January, and maybe February. It's like a combination. So it's kind of an average. Okay. But again, I've done a lot of work on that and I understand how it works, but we don't have to overthink it and get too technical, because you can start to get very technical. Okay. So that's what that's saying there. Okay. Does it all make sense? Great. So the point is, Yassine, that the first answer to your question is that the ZT is looking at the next 24 months. So the thing is, if the market believes that the only change is going to be caused for the December meeting, for example, you just mentioned that Williams had a comment, Mary Daly had a comment. Okay, so what are they really talking about? They're talking about the December meeting. So that might move the December contract for the SOFRs, whereas the 2-year bond, let's say the ZT, is like, well, okay, maybe that changes something for December, but it doesn't change overall that much for the next 2 years. So the question is that something like the ZT or the ZF, which is the 2-year or the 5-year, they will move a lot more depending on like the general economy. It's like, oh, what do you think about the economy in general over the next 18 months or 2 years? Whereas if you have a Fed speaker specifically talking about their view for the December Fed meeting, if you want to trade that more specifically, you should trade the SOFR contract, the specific contract for that month. Or even more specific would be the Fed funds futures, which is the ZQ, which is just 1 month, right? The ZQ, not the SOFRs. The ZQ is 1 month. So if we bring up here ZQ, can you guys see the Interactive Brokers thing here?
Yes.
Yeah, okay. So I put in ZQ, which now this is only 30 days. So the point is, Yassine, if you really only want to trade what the Fed is doing in December, you'd go to this one, and then you go to December contract, Now, I want you guys to notice something here. Look at the price for the ZQ, which is the Fed funds futures, which is only for the month of December, not 3 months, 1 month. You see the price, 96.255, is slightly different to the SOFR futures, 96.265, right? And that difference is because this SOFR December is actually reflecting a longer time frame. So maybe January as well, January and a bit of February as well. Okay. Now, just another thing I just want to show is I think here we can look at the term structure, which is the curve. Okay, can you guys see this black chart with the yellow lines on it, or do I have to reshare?
No, we don't see it.
No, okay, so let me just quickly do this. It's a bit annoying on Zoom, but hey. Okay, so what I just opened up here, this is the SOFR curve now. Okay, and this is the change. So as you can see here, it says 100 minus the price. So what you need to do, if you go on your trading view and you're looking at a SOFR chart and it says, 96.7, that's basically giving you the implied interest rate. But on Interactive Brokers here, they already break it down. So if we just look at the curve here, what is this telling us, guys? What is this telling us? Oops. What have I just done? What did I just do? How do I reset that? Oh my God, such bad charts.
I'm looking at the trading view right now for the ZT and ZQ, right?
Yeah, hold on. Let me just bring this up again. How can I reset this?
I think you need to close it.
Yeah, but then I'm going to have to
Yeah.
share. I'll do it again. Hold on, guys. Sorry about this. It's a bit of a fiddly process. Okay, so what was the question? Okay, so can you guys see the chart, or do I have to reshare that?
I see. Yeah, we see.
You see it with the yellow?
Yeah.
Okay,
No,
so what you can notice here, guys, you see the implied rate on the left-hand side, about 4%, right?
no, we don't see the chart. Still the table.
Okay. Sorry, people are still coming in late.
Are you going to interactive for this?
This is Interactive Broker, yeah.
Okay, let me go there.
Hold on.
Where is IBQR here?
Sorry, so I have to share the chart. Oh my God, what is that noise? Okay, so you see here, guys, what do you notice here? This is going down. And what is that telling you? What is that telling you? Hopefully, I'm going to make it a bit bigger.
Interest rate will go down.
Yeah, so this is telling you where the market thinks the interest rates will be, what the Fed is going to do, as you see going out to next year on the different contracts. Each one represents a different contract. Okay, so the point is that these will change up and down depending on what the market believes. So, for example, if the market believes suddenly that Fed speakers, which Yassine was talking about, Fed speakers come in and start going, oh yeah, maybe we're going to cut in December. Of course, that price will go up, which will push down the yields because the market will imply a lower yield. Okay, but the thing is that doesn't necessarily mean it's going to change. For example, Yassine, December of 2026. That's still, 13 months away. So that means that the December contract versus of 2025 versus 2026 may change differently. And of course, the ZT as well. You have to think of the ZT as being like a SOFR contract for, let's say, December 2027. It's kind of like everything included up to 2027. Yeah. Someone had a question about the on TradingView SOFR contracts. Was that you, Yassine, or someone else? Who else said that?
Not me.
No, that was me, Alex.
Alex. Yeah. So what's your question? Do you want me to go to
Thanks, Angus, for your explanation. It makes a lot of sense now.
Okay. No problem.
Whatever you showed on those tables, I just opened the ZT and ZQ on TradingView and shared the screen like both.
Yeah.
And well, will I see the same dynamics on on the graphics, like you just went
Yeah,
through
it's a different
by
way. So
number.
so the first thing is that there are different ways. I mean, remember, this is a price, the
Right.
ZT. But if we go to, let's say, the SOFR contract, so I'm going to go here to so it's a futures contract. So the symbol is SR3, 3 month
Mm-hmm.
SOFRs. So let's say, for example, we go to December 25, right? Now,
Yes, sir.
that's the price. And by the way, you see, these blue lines represent 25 basis points. That's why I have all these blue lines,
Okay.
because I trade these guys a lot. Okay, so what do we notice about this, guys? So forget all these lines I've put on, but essentially, what do we know? This is a price. So the first thing, as I say, what you have to do is to say, well, okay, um, the price goes up. Why is this going down? Why is this price going up? Because basically, if the price goes down, that is the market becoming more hawkish and essentially saying that for December, we think the implied interest rate, basically what the Fed is going to be doing, needs to become more hawkish. And why is this? You notice the date, it's on the last Fed meeting. Remember when Powell came in on the press conference and said, "Oh, by the way, guys, a December cut is not guaranteed." Do you remember that? Now,
Yeah.
how many basis points did it go down? Can you see the chart? So if we measure it here, you can see that it took out half a cut. You see this? 12 and a half basis points. Exactly. Beautiful. That's why this is a beautiful product. It's very mathematical. Look at this. You see this 1250? Each one of these represents a basis point, which is
Okay.
one. Okay. So basically, what the market did, as soon as Powell opened his mouth,
Yeah.
he said, "Oh, maybe we're not going to cut." The market went, "Oh my God." Okay. So the market decided, let's remove one half of a cut. Now remember, a cut is 25 basis points. So the market doesn't completely want to remove the possibility of a cut. It said, let's take out 50%. 50% of 25 basis points is 12.5 basis points, which is 50 ticks. 2 ticks is 1 basis point, or 1 basis point is 2 ticks. You see? So it's either 50 ticks or 12.5 basis points. And that's it. Now, another way of looking at that is look at the implied. Now, what I can do here, guys, I'm going to show you a little trick, which I use a lot. You can, if you want to get the implied, you get the futures contract, but I'm going to go watch this. You ready? Can you see what I'm doing on the symbol search? Can you see it?
Yes. Yeah. Yeah.
Okay, so 100 subtract, whoops, no, I better put it like this. Subtract, hold on, why is that? We'll do it this way. So you put in 100, subtract, and you put in your SOFR contract, which is December. Now, if I'm correct, I hope, boom, there you go. That gives you the implied yield.
Oh, really? Okay.
So that's a simple way of seeing how the market moves. So the point is you can look at it in terms of the price when you're trading, but it's important to understand the implied yield. So you see, instead of having a red candle for the price, we have the yield. So basically, when Powell started to speak, the market thought that the rate is going to be 3.63, and I said, whoop, no, it needs to be higher. Now, talking about what Yassine said, look how the market has repriced more dovishly over the last 3 or 4 days. You see how the yield has come down. Okay.
Yeah.
All right. Now, the other thing, though, is that another way of doing this, what is this saying here? What is this 3.735 number? What exactly is that? Who wants to answer that?
Where is sorry?
3.73. You see this value. What is this value?
Oh, it went down, right? So the decrease in the price?
Well, this is showing you the implied yield. This is not a price. This is
Oh,
an
sorry, yield.
implied. Yeah.
Okay, so decrease yield.
Right. But what does that mean in real terms?
So that means that based on that, so based on the market, the demand went down. The price, well,
That's not the answer I'm looking for. The answer I'm looking for is what does that number represent? What is that number? 3.73. Is that like what is that number?
Doesn't that refer to the interest that the bond will pay out?
Uh In a sense, yes, yes. Well, that's technically it's the secured overnight financing rate. So with money market participants, that's how much they have to pay on an annualized basis overnight for stuff. So yes, in a certain sense, that's true. But is that what the Fed is going to do? Does this tell us anything about the Fed? Not really.
No.
Now, if you want to know exactly what is priced in, well, it does. Another trick to do, which is actually even better, you see what I'm going to do here? I subtract the effective Fed funds rate, right? And what do you see? So suddenly now you see that really this is actually much more interesting because what this is now telling us is this is what the market expects the Fed to do now. You see, it's a negative, so that means a cut by 14.5 basis points. So you can see that when Powell, well, I mean, we have to 25. So you see what's happening here is that this is showing you the market's expectations for the December meeting. You see they're going, oh, they're going to cut three times, 75 basis points. Oh, only twice. Oh, you see, so this is what it's doing here. This is telling you how many basis points the market is expecting the Fed to cut. Approximately. Okay. It's a little more complicated, but that's approximately what it is. So if we now go to something like the CME FedWatch tool, you guys know about this. This is another way of looking at things. You can see here that for the December meeting, the market is basically saying it's like 87% chance. So what is that actually saying, guys? How many basis points? We go 86.9%, 86.9% times 25 basis points, right? And guess what? It gives us 21.7. So basically what's priced in is 21.7 basis points of cuts. That's the way to do it. So if you don't have the Bloomberg, a good way of doing this is you go 86.9% times 25, because it's saying a 25 basis point cut gives you about 21 basis points. So the question is, Yassine, very, very important. If we were doing an exam and we went to the CME FedWatch tool, which I just showed you, and I said, oh, how many basis points for December is priced in? What's the answer?
The 25 multiplied by 0.825.
Yeah, which comes to 21 basis points.
Yes.
So the question is, guys, and this is very important, and I think it's going to answer your question, Yassine, even in a deeper way. You're looking confused, Carl, but hopefully it's okay. So it's okay. It's all good. Here's the point, guys. If Jerome Powell came out tomorrow, Jerome Powell, the big man himself, and said, by the way, market, I've decided that we will cut in December. Absolutely, we're going to cut. What would happen to the December SOFR contract? Actually, December is about it because it's technically 3 months. Let's say the Fed funds futures contract. What would happen if Powell right now said, I've decided we're going to cut 25 basis points? Would it move?
A bit, just a teeny.
Exactly. Good answer. How much would it move in theory? 4
The
basis points.
remaining, yeah.
The remainder, 4 basis points, which is 8 ticks. So if you look on your TT ladder, it's actually a bad trade. You go, you see what I'm trying to say, guys? It's very mathematical. Now, the point is, though, that the ZT, it's like, oh, that's interesting. Looks like Powell is becoming more dovish. And it's almost like a cumulative effect. So the ZT, which is for the next 24 months, not the next 3 months, the next 24 months, would probably move more, right? Now, I want to show you guys something. Is this making sense? So the thing is, guys, the way to trade this, let's get back to trading. I trade the SOFR contracts a lot. And what am I always looking for? What you need to always understand is exactly what is priced in. Now, when Powell was quite hawkish 2 or 3 weeks ago and said, hold on, Danilo seems to have a problem. Danilo, Anyone looking on Slack? Is anyone having problems?
If you look at the Slack on computer, it's slower than on a phone. Like that's what I experience.
Okay. So here's the point, guys. How do you trade this? Let's say when Powell came out and was very hawkish, right? We saw that the market, boom, within like 1 minute, it repriced 12.5 basis points. It took out half a cut, which is 12.5 basis points. Remember, one cut is 25, so 50% is 12.5. Okay, boom. At that point, I was thinking to myself, man, that's kind of 50-50 now. So all it needs to make money on a trade like that, you can go long the contract, you can buy the contract with the idea that anything dovish, any dovish commentary or any dovish economic data, that will push it the percentage higher. Maybe it can go lower, of course. But I was thinking, is the market going to price out a zero chance of a cut in December? Peu probable, à mon avis. That's my point. So you see how you can trade these things, guys. Now, the other way to trade, does any questions so far? Carl, are you good? Any questions? Everyone gets that? Do you see how you can trade it, guys? The beauty about these is that if you understand the mathematics, you can be very, very precise. Because what does this also mean? This also means essentially your stop loss is 4 basis points. Let's say, for example, you think, no, there's a good chance the Fed will not cut. The data is going to be hawkish. Jerome Powell hates Trump. He doesn't want to cut interest rates or something like that. In theory, a cut is almost fully priced in. So if you're wrong and it goes dovish, you're only going to lose 4 basis points. If you're correct and you think it's going to be hawkish and they won't cut, then actually you can short the contract and your stop loss is only 4 basis points. Your maximum loss probably is only going to be 4 basis points because the market does not think they're going to cut 50 basis points. That's very, very low probability. You see what I'm trying to say? I'm trying to say, guys, that if you understand the FedWatch tool and the SOFR contracts, the pricing, you can be extremely specific with your trades. You don't just go, oh, I'm going to go long, I'm going to go short. And that's why, Yassine, in some ways, it's better. I don't want to say better. You can be more precise with the specific SOFR contracts for each particular month. Because we can look into the future. So, for example, let's look at the CME tool. Things are going to get a bit more complicated. Is no risk reward or no risk, no Ferrari. I don't understand that comment, but who wrote that?
I was trying to say, like, when you said you're only going to lose 4 basis points, but like if you're right, you're going to, like, it's going to be good. So I was like, no risk, no Ferrari.
Yeah, that's the point. It's quite asymmetric, but you could be wrong. But let's look, for example, guys, next June. Aha, that's a bit more complicated. You see what's happening here? See how the distribution now, there's a wide distribution. So what is that telling us? Who wants to explain this? They're basically saying, okay, in December, the market is essentially saying only 13% probability of not cutting, 87% probability of cutting. But if we go out to next year, where we're going to have a new Fed chair, you see that the range of possible outcomes is it's like, aha, maybe they won't cut at all. They'll cut once, they'll cut twice, they'll cut 3 times, they'll cut 4 times. Even there's one point of a 5 basis point, 5 cuts, 125 basis points. So in order to understand what's priced in, you technically would have to go 1.7 times 0, 16.1 times minus 25, 37.8 times minus 50, and then you put it all together cumulatively, and that will give you what is priced in. It's a lot more complex and a lot more interesting so that's the question. Like, Melissa, by next June compared to now, how many times do you think the Fed will cut?
Well, from the chart you showed before, I would say three times.
Forget the chart.
Okay.
That's just the mathematical probability. I'm asking you as a trader.
How
can
many
make something.
times?
It's okay.
There's
You can
no
make
way
something
to.
up. Well, what do you mean there's no way? As a trader, you have to make it.
There's
I mean, just say something. It's okay. We're just here to learn.
So you want me to just give a number that I think might be plausible?
Plausible's good as opposed to ridiculous. Yeah.
Um, let's say twice.
Twice. Okay. So
Yeah.
one way of looking at that is to say, okay, the economy is maybe going to weaken. And the other thing as well, we know that Trump is going to appoint a Fed chair
Yeah.
who is going to do his bidding, who's going to be his,
Yeah.
I don't know, I don't know what word to use, and most probably is going to be more on the dovish side. So I would say twice or three times, but we don't know what's going to happen with the economy. So the point is, what you need to do is to look at the June pricing, right? So let's look at the June pricing. Hopefully this is not boring, guys. Is this okay, or are we bored at this point? Hopefully it's okay. So let's look at the June SOFR contract. So instead of putting this one, let's put in M. Let's see. Okay, it's telling us about 50. But the point is, what you can do, if the market is only pricing in 50 basis points cuts, but you think it's going to be 75, you go, hey, I'm going to go long this thing.
Yeah.
So that's the point. And June is a bit tricky because it's quite a long way away. But you can start to do spread trades as well. There's all kinds of things, of course, you can do. But do we understand the mechanics of that, guys? And of course, this is important because what the Fed funds futures and the SOFR contracts are doing, of course, is also going to be important in terms of what equities do, because we know that equities like lower interest rates in general, et cetera, okay? So it's not just a specialized SOFR contract thing. It's also looking at, what's going to happen with the US dollar. Of course, as the US dollar will weaken if the SOFR contracts go up and the yields go down. Remember, as the yields go down, the US dollar will weaken as well. US dollar weakening, that might be bond supportive. That might be supportive for crypto. There's all kinds of, interrelationships, of course. Other final thing, just to finish on this one. I'm not sure if you guys are aware of this, but there's also another fun tool at the CME called the what's it called? SOFR Watch. So this is actually quite interesting for trading, guys. Now, can we see this? Can you guys see this?
Yes.
Yeah. Okay. So I've got a lot of stuff on my screen. It's hard to see. Okay. So first of all, you see this. Now, what is this telling us? Let me just move it up a bit. What is this telling us? Okay, so you see you have the thing. This is telling us what is currently priced in by the SOFR market. So you see the December meeting, minus 25 basis points. You see that? Nothing. And then it's got for April, 25 for July, boom, boom. So that's basically telling us what is priced in the SOFR market. Now, the fun thing about this tool is that there's the term structure. So the term structure is just a fancy word to say, what every individual contract is pricing at, right? And you've got the current price here in the differential. Now, let's say, so what is priced in, guys? 1 cut, 2, 3, 4. They're saying by December of 26, 100 basis points, you see that here, are priced in. But let's say we think that the new Fed chair, Trump's going to say you need to cut more. And let's say what we're going to do here, you see what I'm going to do? I'm going to add another cut. See this? Minus 25. So I've gone from 0. I'm going to add one more cut. Now, what I want you guys to do, and then I'm going to calculate, and you're going to see this change. Boom. Okay? So you see suddenly it's changed, and that'll tell you on the different contracts here, the differential. See the differential? Like 12 basis points, 11 basis points. So that's basically telling us that suddenly, there's 15 basis points difference or reset. You see it reset. So the point is that that's a fun way of testing your strategies. So let's say, Melissa, for example, you think, no, the economy is going to be amazing. Trump's going to pump everything leading up to next year's midterm elections. The new Fed chair will actually be more independent than everyone thinks. And instead of cutting 4 times, the market is being way too dovish, they'll only cut twice, for example. You can put that into that SOFR Watch tool, and it will tell you which contract will move by how many basis points. And that can help you determine, where the trade is. Also, which contract is going to move the most as well. So that's a fun tool. Okay. All right. Maybe that's enough on the SOFRs for today. Let's take any other question. What's another question? Maybe nothing to do with the SOFR. Does that help, Yassin?
Yeah, for sure it helps. Thanks. It helps a lot.
Good. Okay, we'll keep on talking about it. All right. Another question, different subject. Who has another question?
Oh, I have a question, Angus.
Who am I speaking with, please?
This is Henry.
Henry, hello, because I can't see you.
Hello.
But, yeah.
Hi. I've been watching all your video and on the section on the bonds.
Right.
The question I have is more regarding to the currency, because I'm into Forex. I'm
Okay.
really into my Forex journey. I just started. I'm planning to do future in the future. On
Future.
the current, yeah,
Did you say planning to trade futures in the future?
I'm planning to trade future in the future. Yeah.
Mhm.
So my question is for the currency, because I've been only solely focused on the US.
Okay.
Sadly, today and tomorrow.
Okay.
Yeah.
When you say US, you mean the US dollar or the
The
American
US dollar.
economy? Okay,
US
first of all,
dollar.
guys, what is the US dollar? It means nothing. That's a very important concept, Henry. Trading FX, first thing, let's be very clear. The US dollar means nothing. It's the US dollar compared to other values. Let's call it the euro or the British pound or whatever. Okay, so just keep in mind, the US dollar needs to always be seen in context with other things. But go ahead.
Yeah, got you. So now I've been focusing on the pairs. I've been using the DXY as my benchmark to compare.
Okay.
like
First of all, sorry to
Yep.
interrupt, but I'm just trying
Yep.
to do this stage by stage.
Sure.
Can you tell me what the subcomponents of the DXY are, the dollar index?
The DXY, I think it's the US dollar compared to the euro, the British pound, the Canadian dollar, and I believe also the Japanese yen, and also the Australian dollar. Could that be it?
Not bad. There's also what is the weightings of those different currencies?
Oh, that's a good question. I don't know.
Okay, so the first thing, guys, very important, and I'm going to be annoying, but everyone who knows me knows I'm a bit annoying. If you say something, every time you see a term or something, you need to think about it. Just stop. So when you see, the dollar index, it's important to understand, just FYI, you can do a quick Google search or ChatGPT. From memory, it's about 57% weighted euro, 57 or 58% euro. So important thing to understand, Henry, is that when you're looking at the so-called dollar index, you are in many ways trading, I'm not going to say it's totally the euro, but it's almost 60% euro. It's very, very highly correlated to the euro. Okay. The second thing to understand about the dollar index is that's quite an old index, which is good because there's a lot of data and everyone trades it and there's futures. But the bad news is the dollar index is very Eurocentric. European centric. It's got the euro, it's got the Swedish crown, it's got the British pound. Does it have the renminbi, the Chinese currency? No. So understand that in the DXY, which when you're trading it, it's one way of looking at US dollar. It doesn't have the Chinese currency. It doesn't have emerging markets. It doesn't have the Brazilian real, which, for example, is the Bloomberg dollar index, which is much more comprehensive. So I'll leave it at that. But just to say that when you're looking at the dollar index, understand that you are in many ways trading a very European-focused, even Euro-focused index. And it's always very, very important to be looking at the dollar against, let's say, the Chinese renminbi, Korean, like other currencies. Anyway, I'll shut up there, but go ahead.
Okay, so no, I didn't know that. So that's really
Good.
interesting to know.
Good.
So what will be like the other indexes?
Carl's just put it up. There we go. 57.6%. Yen
Yeah, it's in trading view.
pound. Yeah, exactly. So the point is, guys, I mean, it's not bad. For sure, the dollar index is very, very important and everyone trades it. And you need to know exactly what's happening. But I'm just trying to make the point that, it doesn't have, for example, China. But anyway, go ahead, Henry.
Yeah, so the question that I have, knowing this, what would be like the other indexes or other way to use as a benchmark to measure the US dollar in that case?
Well, the dollar index is a benchmark.
Right.
So are you saying what factors influence the
No,
US
it's
dollar?
what also other besides the DXY could I also refer to
Well,
as a
the
benchmark?
classic which people look at is the Bloomberg index, which is BBDXY. I'm not sure if that's on TradingView. And the Bloomberg dollar index is a lot more comprehensive. It has a lot more currencies, basically, as I said, emerging
Oh,
markets and
okay.
stuff like that.
So if I'm looking under TradingView, I will not have that, right?
I don't know. You'd have to check. I do
I'll have to
believe.
check.
I do
Yeah.
believe recently that TradingView actually did introduce on the dailies actually a bunch of Bloomberg indices. So maybe there's a brave new world out there. So if we go to all, I'm kind of curious. Bloomberg. I wonder if they might actually have it. I mean, that would be kind of cool. Bloomberg dollar. Oh, forward index. No, that's the forwards. Because Bloomberg, they protect everything. It's like BBDX or something like that. Hold on, let's have a look. No, I don't know, Bloomberg. Anyway, check it out, but they could be there. The other one as well, but see, the problem is though, Henry, a lot of these things are proprietary and they make you pay money for it. The other one for emerging markets is MSCI, emerging EMFX, MSCI, EMFX, which is more for emerging markets. But the point is that what I would say, Henry, if you want to know in terms of stuff, I mean, another way of looking at it, which you can also, for example, there's the Euro index, right? Which is like the dollar index. People don't talk about it quite as much. But if you're basically saying, hey, I sort of want a bit more of a general sense of what's happening with FX, you see here I've got the dollar index, right? Okay, but you see here EXY, it's a basket of currencies against the euro. See this EXY on TradingView, EXY. So that will give you an overview. But the point is that really you need to be scanning through. See, I've got all my FX pairs here. And then I've got my cross pairs. So really what you need to be doing is at least scanning through, if you're an FX trader, you need to know exactly, obviously, US dollar versus the euro. Then you want to know against a risk of currency, let's say like the Swiss franc, the Japanese yen you need to know. And then normally you need to have some sense of, let's say, commodity currencies. Let's say like the Aussie dollar is very, very important. And let's say maybe New Zealand and Canada a little bit. Then I would recommend always keeping an eye on a couple of classic sort of emerging market or sort of high beta currencies like South African rand or the Brazilian real is a good one. And then, of course, you want to look at some of your risk on. I mean, what you're trying to figure out also is risk on, risk off. So, guys, what's a classic risk pair? Like if I said to you, global risk for FX, what would be a classic pair which people trade?
Euro, USD.
To a degree.
Australian dollar.
Australian dollar is better, yeah. But what's even more a cleaner expression of risk on or off? Something like the Australian dollar versus the Japanese yen, or the Australian dollar versus the Swiss franc. Okay, because you're looking more extreme. So you've got something like the Swiss franc, which is a sort of a safe haven, and you've got something like the Aussie dollar, which is, sort of pro-trade, pro-China, all that kind of stuff. So it's much more extreme. So the point I'm trying to say, Henry, is that if you're looking to understand the dynamics which are driving the FX market at any given time or at any given day, I normally look through the 5 or 6 main pairs against the US dollar, euro, yen, pound, Swiss franc. You go, okay, great, Aussie dollar. But then I have a quick look, and this only takes 10 seconds. I would look at the Australian dollar versus JPY, Japanese yen, maybe the Aussie dollar versus the Swiss franc. And then in terms of European stuff, like for example, a great trade at the moment, the whole situation in Ukraine, that let's hope there might be a ceasefire. So how could you express that as a risk on, risk off kind of thing? What are we talking about here? We're talking about sort of a situation, maybe not so much globally, but more specifically like European risk. So what could be a nice expression of that? Like risk internal to Europe. Anyone? What about something like the euro versus the Swiss franc? So in the context of Europe, the Swiss franc is the safe haven versus the euro. So when you have a risk-on situation, yay, peace in Ukraine, the euro will outperform the Swiss franc. And vice versa. If there's some kind of drama, let's say with French politics and the French bond market or the Italian bond market or whatever, the Swiss franc will tend to outperform the euro. Now, if you want to be even more granular and a bit smarter, I don't want to say smarter, maybe a bit more granular, you could do something, for example, like what's a currency which is very, very exposed, let's say, to Ukraine and all of that? Poland, the Polish zloty, which I think I mentioned in the video a couple of times. So a classic way of expressing risk in Europe, as it pertains not general political risk, but let's say Ukraine, would be long Polish zloty, PLN, versus the euro, right? Because remember, Poland is next to Ukraine. They do a lot of construction, a lot of business. So if you look at the chart, I mean, not so much the last day or two, because Poland has its own internal sort of political things. But if you look, let's go on a longer term chart. So we go to, you still with us, Henry? It's all making sense?
Yeah, making sense. Thank you.
Okay, so you got euro versus the Polish zloty. And let's go on a weekly chart just for context. So it's TradingView weekly chart. And what you guys can see here, so see on this weekly chart, when did war break out? When did the Russians invade Ukraine? There'll be no big prizes, guys. On a weekly chart, look at this. Oop, boom. This is the euro accelerating versus the zloty. You see this? This is 3 weeks, or actually 2 weeks, 2.5 weeks here, the weekly chart. You see? Now, the euro, on the other hand, just to emphasize this, so is that clear? Everyone have questions there? So you see the euro was like, oh my God, this is horrible for Eastern Europe, so we better short the Polish zloty. So the euro goes up. But let's say, for example, if we look at the euro versus the Swiss franc, if we go on a weekly chart, what do we think is going to happen? Mr. Alexandre Leto, what would happen on a weekly chart, euro versus Swiss franc? What would we expect?
I have absolutely no idea because I just started, so I don't understand anything so far.
Ah bon?
I'm like so new. I don't know.
Well, that's an honest answer, I suppose. Okay, but look at this guy. So this is now the euro versus the Swiss franc. Which is the safe haven? The safe haven, of course, is the Swiss franc. So look what happened. Again, if we go back to 2022 when the Russians invaded Ukraine, look what happened to the euro against the Swiss franc. Sold off pretty, like, this is weekly chart, guys. It sold off for like basically 3 or 4 months. Right? I mean, there's other factors, obviously, inflation, et cetera, et cetera, et cetera. I'm not saying this is all geopolitical news. So, does that make sense? There's different levels of exposure. So what actually would have been the best trade, guys? What would, if someone told me the following trade for FX, Henry, what would be the perfect trade using a butterfly, three FX? What would you do? You'd short the euro, you'd short the Polish zloty, and you'd go 2x long the Swiss franc. Oh my God, there's a beautiful trade. Beautifully hedged. Oh my God. So the Swiss franc would outperform the euro, and the euro would outperform the Polish zloty. So you go long 2x Swiss franc, and you short on a butterfly wing, you short the euro and the Polish zloty. Anyway, that's getting a bit complicated.
Thank you. On these pairs that you just mentioned, does that require a lot compared to the mains ones? Meaning that if we place a trade, do we need to have like a certain minimum amount?
No, the way it works on the spot market, we're not talking futures, very different. But on the spot market, the difference will be reflected in liquidity and the spread, right? So if we go, let's say, to not TradingView, to Interactive Brokers. Can you guys see Interactive Brokers account here? Sorry guys, I've got a lot of junk up here. But just guys, just tell me because I don't know what you're seeing. You're seeing
Yeah, we see Interactive Brokers.
okay, so I'm going to go into FX trading. Now, oh look, anyway, we won't go into that. But the point is, it's got to be reflected on the spread. If you're trading, let's say, Henry, you're trading USD versus JPY or the euro, what's the spread got to be? It's going to be like one pip or 2 pips. Very, very tight spreads, right? But the more illiquid an instrument, the more exotic. And something like the Polish zloty is getting, semi-exotic. Instead of having 1 or 2 pips spread, it might be 10 or 12 or 15 or 20. So basically, it's like the commission. It's not that you need more margin or anything like that, but essentially the broker will say, hey, there's not as much liquidity, and they will hit you on the spread. So you may have to pay, 10 or 15 ticks as the spread. So the less liquid the FX instrument, the spread will be wider. Okay, and that's going to be the difference. But you don't need more, money or margin or something. Make sense?
Makes sense, Angus. Thank you.
Yeah,
Well, the
yeah.
last question that I have is
Go
for the
ahead.
chat pattern.
For the
is that
which pattern?
chart pattern for stocks, are they necessarily the same
Whoa. Sorry, I'm
under
not following you. The CAD, Canadian dollar?
for any currency in general?
Right.
Are the chart pattern or relatively the same from stocks to FX, or they're totally different? Because I can't see anything related to the cup and handles.
No. Okay, you're talking about technical, and your question is, do the principles of technical analysis apply across asset classes? And the answer is yes.
Okay.
So, sorry, just the short answer. So yeah, if you're using Fibonacci's, or I wouldn't obsessively focus on cup and handles, just by the way, in parentheses. But yeah, if you're using, trend lines, Fibonacci's, Fibonacci extensions, exponentially weighted moving averages, all of the arsenal of tools in classical technical analysis on stocks, individual stocks, is that applicable to the spot FX market? The answer, tout simplement, is yes. But then the real question is, well, what's driving the FX market? You really have to start understanding, geopolitics and technicals, but also interest rate differentials. Very, very, very important. Central banking stuff. Really, where you're going to make money as an FX trader, you need to understand, obviously, politics and technicals. That's a given. But really, it's about interest rate differentials. So you really need to be understanding monetary policy of particular central banks. So let's say, for example, what the ECB is doing versus, for example, what the Fed is doing. So Henry, if I said to you, what's the ECB overnight rate today, and how much have they cut in the last year? Can you answer that question?
Sorry, no.
No. So again, I'm not being annoying. I'm simply saying where you're going to make money is in the interest rate differentials. So keep in mind that the ECB, European Central Bank, they've cut interest rates to 2%. They've cut substantially over the last 12 months, right? Whereas, for example, the Americans, as we know, they cut once and then they haven't, and now they're cutting now, and the whole thing with the Fed. So really what you have to understand is you have to start thinking in terms of interest rate differentials and where the market might go. So you'll see on my trading view, can you see the trading view? So the way I've got it set up, I have the main pairs, then I have the cross pairs, and what you'll notice is that I've got FX differentials, right? So for example, I've got the US 10-year minus Japanese 10-year. So let's check that out. Can you see this chart? I'm not sure. Okay.
Yeah, we see it.
Yeah, it's on let's put it on a daily. Sorry guys, I've got this stupid thing keeps on popping up. I can't see my charts. Okay, so there's the daily. So what is that telling us in simple terms? This is simply the differential here between the US 10-year yield and the Japanese yield, which used to be very high. Let's go back in time. So you can see this thing changes quite a lot, right? Actually, let's get rid of all the drawings. So you can see that at the peak, if we go back to October of 23, basically a US 10-year yield was giving you 415 basis points or over 4% more than the equivalent Japanese yield. So the point is that it makes more sense. I mean, it gets complicated, but if we really simplify it, to put your money as an international investor, let's say in US treasuries, of course, you're getting 5 or 6% compared to Japanese treasuries. If you buy a US treasury bond, what do you need, Henry? If you're buying a government bond, what do you need? You first of all need that currency. So let's say, for example, I'm in Canada and I'm looking at US, and I look at the US treasury market and it's giving me 5%. Then I look at the JGB market, the Japanese government bonds, and it's giving me 1%. And I go, I get 4% more in the US than I would in Japan. I think I'll take my, $100 million of Canadian, if I'm an institution, and I will convert that into US dollars because I need US dollars to buy those US treasuries, right? And in doing the conversion, guess what? I'm technically selling CAD, buying USD, which is a positive for USD. So the point is that as those interest rate differentials are constantly changing, institutions are constantly balancing in the flows. So in general, one of the factors, and this is a complex discussion, you should always be looking. So for example, what we're going to do here, we're going to add USD JPY. Oops. You see what I'm doing here? I'm adding USD JPY to our chart. And I'm going to see what the correlations are. And this is very interesting. Well, actually, let's go on a weekly, maybe. And what's interesting about this chart, guys, is that the differentials historically have been very correlated. What do I mean by the correlations? It means that as the differentials go more and more in favor of the US, historically, that's meant that the USD has gone up versus the Japanese yen and vice versa. It's very sensitive to the correlations, right? So if the differential comes in, and the US Treasury. So for example, what's been happening to Japanese bonds? What's the big news over the last 12 months? The Japanese bond yields, which have historically been super, super low, they've been going up. US bond yields, kind of 4.5%, 5%, depending on the tenor. So what does that mean? It means the differentials are shrinking. We saw back in 2023, the differential was like 420 basis points. It's come down. So that means, what does that mean? In theory, that should be at the margin, the US dollar should weaken against the Japanese yen. And what's actually very interesting at the moment is that it hasn't exactly done that. So it's not obeying the correlations. And again, on TradingView, what you need to do, if we put it on the day, you can do the correlation. There's a correlation function, right? You guys know that, right? So what you need to be doing is looking at these things and going, wow. And look at this, guys. Look, you see how it's decoupled? Kind of weird. So we see that the differentials are going down, but the USD is sort of still maintaining a certain amount of strength. That's unusual. This gap has to close. This has to come down, or that has to go up. There's a historical divergence. Anyway, don't get into that too much. That's because interest rate differentials are not the only factor. Obviously, in Japan, there's concern about a lack of fiscal discipline, that they're basically spending too much, they have too much debt. So the weird thing about the Japanese yen is that the Japanese yen is slowly starting to trade like an emerging market currency, like Nigeria or something. The same as the British pound. Normally, guys, is that in so-called developed markets, as interest rates go up, that should be supportive for the currency, unless the market believes that the interest rates going up is not healthy growth, but it's too much inflation and it's too much debt spending, in which case the logic flips and the market goes, oh my God, the government's out of control, the treasury is out of control. We're basically in an emerging market where they're just spending and printing money, and it becomes an inflationary problem, and the currency actually depreciates. And what's incredibly interesting is that we're starting to see that, actually not, we have been seeing that in the Japanese yen for the last 18 months, and also currently with the British pound, right? Which is not good. It's not good. And some people are also saying we are also seeing that a bit in the US dollar. Although, as I said at the beginning of your question, Henry, the US dollar en soi in itself is kind of a meaningless term. You got to go US dollar against what? But if you look at the US dollar against gold, I mean, has gold been going up, guys? Not really. Gold has been going up denominated in US dollars. So think about it that way. Don't think of gold as having risen. You think of the US dollar being depreciated or debased against this thing which we happen to call gold. And it's also very important, guys, when you look at gold, for example, you look at it in other currencies. Do we do that? Okay, so just don't think like, oh, gold. Gold is at, $4,000. Okay, dollars. You need to be looking at gold. For example, if you look at gold versus Japanese yen, it's even more extreme. So and the reason I'm saying that is that these ratios are kind of interesting just to put everything into context, to give you little clues about the market.
Very interesting, Angus. A quick question with regards to that. So if you look at gold across most of the currencies, it has appreciated.
Absolutely.
What would you...
So let's stop there.
What else? Would you compare it to?
Okay, yeah, but so the point is that you got to think, what is that telling us? A simplistic way of looking at it. So, for example, I've got gold here. So here's gold USD. And again, let's put it on a weekly chart. So we get it. Okay, we all understand. This is a weekly chart, gold USD. Great. If we look at gold Swiss franc, euro, also very powerful. But I'd be curious, for example, to look at gold.
Swiss franc a little bit less.
Yeah, maybe in theory, I'm imagining maybe a little less. Still powerful. Well, it's still pretty powerful.
Yep.
So what is that telling you guys? It's telling me, in general terms, that it's not so much a US dollar weakness or gold strength. I think it's a much bigger issue, and I'm not saying anything particularly interesting or revolutionary here, of a lack of trust in fiat currencies. In general, there's a general sense, and you see that if you look at all 30-year bond yields, most 30-year bond yields over the last year in developed nations, the UK, US, Japan a lot, the UK, Germany, all of those long, like the 10 and 30-year yields are going up. The world, when I say the world, markets, investors are concerned that there's a trend that governments globally are spending too much money. Governments have become way too comfortable with too much deficit spending, quantitative easing, all this stuff which happened after the great financial crisis and COVID. And I think if you're a politician, I mean, let's think about it, guys. If you're a politician and you look at COVID and the central bank comes to you and goes, hey, we can spend 500 billion Canadian and give everyone a $2,000 check. And the politicians go, how does that work? And you go, well, the central bank, they kind of buy it. They just invent money and they put it on the electronic ledger. Now, as a politician, that sounds quite attractive to me. You go, oh my God, and it's not going to cause inflation. And you go, no, it's all cool. Modern monetary theory. Of course, it did end up causing inflation. But if you guys remember, back in 2020, it was like, oh, there's no inflation. And, anyway, point being, to get back to your question, I think it's a much bigger question about concern globally of markets that, governments essentially have lost any fiscal discipline. And it's just a question of degree. So it's a kind of more a debasement of fiat currencies. Now, of course, the Bitcoiners will say, aha, that's why Bitcoin is kind of exists. Gold, hard assets, real estate, art, vintage wine, vintage car. Look at the vintage car market, for example. I mean, I know it's a sort of a stupid example, but I think anything which is perceived to be a real hard asset, and also slowly commodities, I do believe, will become, if you look at the Bloomberg Commodity Index, it's creeping higher. because commodities is like real stuff. But again, guys, I don't like talking like that because I'm not a conspiracy theorist who likes to talk about what's going to happen in 20 years. I'm a much more a short-term trader. But I think that's the big picture. Yeah.
Hey, Angus.
Yes.
A question on that. So if there is a thesis of debasement of fiat currency,
yeah,
why would 30-year bonds trade more expensive? Wouldn't they fear the inflation and debasement?
It's complex, and it's. I mean, okay. The question really is what drives the yield on a 30-year bond, and it's a combination of 4 or 5 things, right? So first of all, we have to say there's no simple answers here because there's always. I mean, the interesting thing about bonds and yields, guys, is that it's a bit like oil, right? At a certain point, if the yield goes so high or the price goes so low, it starts to represent an attractive value. Like if I said to you, you could buy US 30-year and get 15%, you go, actually, that's not bad. And then that will suddenly bring everything back into equilibrium. So the point I'd like to make, Danilo, is that at a certain point, there is always going to be an equilibrium. But let's just look at the decomposition of what is the yield. The yield is, getting back to Yassine's point about the SOFR. If I put my money in a 30-day, not year, 30-day money market instrument, and every 30 days, I just roll it over, right? Technically, the 30-year yield should be, what's that? 360 times that payment. It's like the 30-year yield is a combination of monthly yields taken out 30 years. So that's the base yield, right? Then, of course, the 30-year yield worries about inflation expectations. Where does it think inflation will be over the next 30 years? It also worries about, obviously, things like geopolitical risk. It worries about central bank independence and the ability to fight inflation. Let's call it central bank credibility. Risk of default, that's not really a problem for the US, for example. It's a problem for emerging markets. It's not a problem for the US. And what else? Also issuance. But issuance is kind of like deficit spending. Is the government or the treasury going to be issuing too much? So the thing is, whenever we have a discussion about the 30-year yield, we have to put all that stuff into the pot and mix it around. And what's interesting is that one of those factors I mentioned, which is inflation expectations, if you actually look at something called inflation swaps, which is essentially a market way of trading where the market thinks inflation will be in 1 year, 2 years, 5 years, 10 years, or 15 years. The interesting thing is that the market doesn't believe that inflation in 10 or 20 years will be that high. It doesn't, if you look at inflation swaps, the 30-year tenor, it's not like at 8 or 10%. It's actually a little bit less than where it is now. And some of that could be due, some people talking about, increased productivity because of AI. There's an argument there that, medium to longer term, actually, AI is going to reduce inflation, et cetera, et cetera. There's a lot of factors. But so what was the question? I was trying to, what was the question again? Just talking about 30-year yield factors.
I know that's great so far, but the question was, so if there was the belief of debasement and inflation, why would the 30 years be trading higher? But
When you say higher, do you mean the yield or the price?
The price.
Because
the yield would go lower if the price go high.
Because what causes the debasement is the issue, it's deficit spending, is the government spending more than they receive. Where does that money come from? It comes from the money the government spends, very simplistically, it comes from tax receipts. But if your tax receipts are not enough to cover your costs, you need to issue bonds, especially long-term bonds. Well, not only long-term bonds, but you issue a certain quota of long-term bonds. And that's a supply and demand thing. It's like building too many condos. It's a supply and demand thing. So one of the reasons is that, the 30-year yield has gone up to about 5% over the last year. It's down now lower than that. It's kind of the same thing. It's like when we talk about debasement, it's essentially because the government is spending too much. Or what does that mean? Oh, they need to fund it by issuing bonds. Oh, they're issuing too many bonds. The market, in order to absorb all of those bonds, says, hey, I want to be paid more yield. So the debasement trade is sort of the same thing, or a result of extra bond issuance, right? Now, another effect of that, of course, is that the currency in which all of this is happening, let's call it the US dollar, is also affected, but only on a relative basis. And that's my point about gold. Gold is appreciated against almost all currencies. So we can't just go, oh, the US dollar, it's all fiat currencies. Remember, and this gets back to Henry's question about FX. Remember when we're talking about the US dollar and FX trading, it's relative. It's all relative. Like the euro has depreciated against gold. The euro is garbage as well. You wouldn't want to just put your money in, if you're in Europe, you don't want to just put your money in the bank account and get 1%. You're going to lose money. So let's just keep it in mind, guys. All of this stuff is relative, and all FX trading is relative values of garbage.
So in the end, it's a matter of
it's
inflation.
It's the least dirty shirt. So some people, if you agree with this theory, would say, I don't want to have any fiat currencies. I mean, I'll trade it, but I don't actually want to own any. Like, I don't see any real reason to keep your money in the bank. So therefore we say, where am I going to do it? Now, what I'm trying to say, though, about the 30-year bond, which is interesting, is that at a certain point, the 30-year bond struggled to go above 5%, if you look at the chart. Why is that? Because at a certain point, you can say, yeah, but AI is coming in. Longer term, it's going to be good for productivity. And maybe Trump, with all of his tariffs, actually going to weaken the economy, and global trade is going to break down. And it's so the point is, guys, it's always in balance. That's why, some of these big picture theories, they're Sunday reading for me. Sunday reading. Remember, as traders, we're just trying to figure out what's going on in the next week or month or 6 weeks or day or whatever your time frame is. I'm very skeptical about trying to trade these huge themes. It's really just, in my humble opinion, a question of understanding the 3 or 4 factors which influence every asset or every instrument on a micro level. So, for example, it's pretty simple. If it looks like the economy is going to collapse, the 30-year bond will rally. If inflation's high, the 30-year bond will go down. If the US Treasury at the quarterly refunding announcement announces extra issuance, the bonds will go down. And we saw this, I don't know if you guys saw, I posted, it's a very good way of looking at this. We'll maybe finish on this, getting a bit late here. When the rumors were announced a few days ago that the new Fed chair could be Kevin Hassett. Remember I posted, I don't know if you guys saw that. Very instructive and a very good way of learning about bonds. What happened is that initially the bonds went up. It's like, oh my God, we've got this new dovish guy who's a buddy of Trump and he's going to cut interest rates. Now, Yassine, that's very good for the extreme front of the curve, in theory, if it's not priced in. But the problem, guys, you always have to use the analogy of the doctor, which I know is a bit pathetic and simplistic, but I do like it. If you think about inflation as being a fever, right? And the doctor is the Fed. So if you have a high fever, what does the doctor have to do? Has to give you the tough medicine, the high interest rates. So it's very instructive the way the market reacted, because essentially what happened is that the front, like the ZT, the 2-year bond, which is kind of a proxy for the Fed, that continued, it rallied and continued to stay, high. Whereas during the day's session, you saw the 30-year bond actually went below the initial price, causing the curve. So what's happening? So the yields on the front end are going down. It's like, oh, they're going to cut interest rates. Yay! But the yields on the back end eventually went up more on a comparative basis. Because think about it. You go, hey, the doctor has seen the inflation, but the new doctor, we have a new doctor, new head of the Fed. He doesn't believe in tough medicine. He doesn't believe in hiking interest rates, even with sticky inflation. You go, oh, great, I don't get any tough medicine. Yay. And then after half an hour, like literally the markets think. And after an hour, the market goes, hold on, no medicine for inflation or the high fever. That's actually kind of bad over the long term. right? Because also, think about it. If you're getting a new Fed chair in 2026 who's going to turbocharge the economy with artificially low rates, okay, that's nice. It's going to pump up probably the stock market and the economy. But that also means that inflation will not go down. And the long-term bond market, if you look at the maths, Google or ChatGPT, guys, effect of inflation over a long-term bond. It's insanely destructive. Even like an extra 50 basis points of inflation over 30 years is going to take down your... Because remember, guys, people invest in 30-year bonds. Where's your income coming from? Your coupon payments twice a year, right? Now, guys, when was 30 years ago? That was 1995. Imagine, guys, institution or an individual buying a 30-year bond in 1995. Imagine 3% or 4% inflation every year. Remember, the coupon doesn't change, guys. If you buy a 30-year bond today for 4%, you're going to get that for the next 30 years. So let's say, for example, you're getting a coupon payment once a year of, I don't know, $1,000 for your bonds. What did $1,000 buy you in 1995 compared to what $1,000 buys you now? And by the way, we haven't had much inflation over the last 20 years. Remember, inflation's been globally suppressed. So actually, it's been amazing for bonds. But as soon as that calculus changes, oh my God, you don't want to have 30-year bonds. And that's why the bond market is not sure at all about a dovish Fed chairman. And trust me, we saw this with Liz Truss, remember a year or two ago in the UK, the Prime Minister? She said, oh, we're going to spend all this money, but we're not going to increase taxes. And the bond markets went crazy. Bond vigilantes. Trust me, guys, there's a very interesting chance, in my humble opinion, if the Fed chair is too dovish next year, the long-term bond markets will revolt. What do I mean? They'll say, hey, you guys are not serious about fighting inflation, and the economy is being artificially turbocharged. The long end yields especially will go up a lot, which is going to be very, very nasty for stocks. So two solutions. Either the economy just weakens, or the Fed chair actually is a lot more independent than Trump wants. And that's going to be an interesting political dynamic if the new person appointed by Trump basically says, hey, we still have inflation at 3.5 or 4%, Mr. President. We can't really cut anymore. Well, Trump's reaction is not going to be pretty. But that's probably a story for, next year. We'll save it. All right, guys, I might leave it at that because it's lunchtime for me. I hope that was useful. So thank you for that. I'll try and do this, guys, once or twice a week if that's of any use to you. As I say, what I'm trying to do here is to we have the time to explore a few different concepts, hopefully to clarify one or two things. So let me know if that's useful. And on Slack, if you don't like it or you want to change the format or something. But guys, we can also look at some individual trades and trading ideas as well. It doesn't have to be purely like theoretical discussions. I'm also very happy to look at specific trades you guys are in or thinking of doing, or maybe stuff I'm looking at, whatever. Okay. All right, guys. Take care.
Thank you very much, Angus.
My pleasure.
Thank you.
Have a great day.
Thank you, Angus.
We'll talk, I don't know, maybe another
Thank
few
you.
days or something. Ciao, guys. Take care.
Take care.
Bye.